Welcome to the Organized Investor PodCLASS with Jerry Goodman and Megan Hubbard from Tennessee Wealth Management. Think of these pod classes as a college of knowledge, and the curriculum is an inside look at how we work with our clients to organize their investments, their retirement, and their affairs. Our process is certainly not the only approach, but it has served our clients well. Listening may materially improve your life as well, but for that to happen, it also takes an open mind, an interest to learn, and your trust in what we're sharing. We focus only on what is relevant and will explain things several times in different ways over multiple classes to ensure you understand their importance. We suggest you subscribe so you'll receive reminders about the next class. And with the tools and information on our website, theorganizedinvestor.com, you can start getting organized right now.
Welcome back, students, and this is our 9th PodCLASS in a series about organizing your investments. Perhaps you've heard the term product pollution, and for investors, they're being subjected to it more and more each year in the form of new and improved and more complicated investment choices. You have to look no further than the commercials on TV where they're explaining what is either a new version of an old investment or even newer versions of new investments.
And unfortunately, this creates a whole lot of distraction for investors because, each time this new shiny dime comes rolling down the street here, it's yet one more temptation to consider that notion. But, new is always better than old, isn't it? So chasing that next new best investment idea with your long-term retirement dollars might cause you some real issues down the road. So in this podcast, and this little episode, we're about to explain the goals and the processes that we use that we think can materially improve your financial future, and also explain why it took so long for us to actually adopt this approach.
Hello again, it's me, Megan Hubbard, and I'm here along with my dad, Jerry Goodman. And I'm not sure I know what this next phrase really means, but we are pleased as punch you've joined us today. So not really sure what it means, but it sounds fun and festive, right?
Yeah, I would think maybe pleased with an adult beverage even sounds better, particularly on a Friday afternoon.
I guess so.
Yes.
Well, you can think of us as Megan and Dad. And oh, by the way, when I'm at home, I'm also called by the name of Mom. I have 3 kids, so I go by that as well. So you can call me Megan or Mom, whatever. I'll answer to it all. I'm a former first grade teacher at Christian Academy of Knoxville, and Dad was the manager of Wells Fargo Advisors Office for 7 years. He survived. He's here with us today. He lived to survive and tell the story about it. I have a master's degree in curriculum and instruction, and Dad actually graduated with an accounting degree because he wanted me to tell you all this, that he wanted to give credit where debit is due. One of his funny accounting jokes.
There's only 3 accounting jokes, and that's one of the 3.
Well, I can't wait to hear the other 2. That one was so funny.
Oh, yeah, they're just all real side splitters. So, Megan, I realize you're no longer a teacher, but you may be interested to know I saw the other day, safety experts say that school bus passengers, that they should be belted.
Ha, ha, ha. So Were you, when you were in school way back when, did you go to the principal's office and get paddled a lot?
Well, no, they just paddled me in the room. I had to go to the principal's office. I actually never got belted, but at least by the teacher. I got paddled once and never belted. So anyway, so while we're talking about the teachers that didn't belt me, we can say that teachers are supposed to know more things than the students. And in theory, the financial advisors probably know more about some things than their clients. I mean, sometimes I'm not sure that's true, but that's the general concept here. And teachers are there to educate those students and offer some advice, as well as financial advisors. They do kind of the same thing as well, or at least they're supposed to, aren't they?
Well, yes. And as the name applies, an advisor is about giving advice, right? But for a financial advisor in a fast-moving world, it's hard to predict how their advice might have to change. So even though investment choices will change, I will say the core rules and principles of investing, they don't change. So it requires a lot of thought and wisdom to integrate the things that have changed with the rules and principles that have not changed. And it's okay if everyone doesn't agree on how that integration is supposed to take place or what should happen for that to take place. But as long as the rules and principles are followed, then we can all agree that we're on the right track.
That word integration, that's an interesting little term, isn't it? It's so flexible. It kind of pops up in so many conversations. I don't know why I thought that, but it's just kind of
Our word of the day.
Well, it's kind of like I remember a friend of mine used to always use the word vis-a-vis, and I'm not really sure I even know what it means, but he liked it. So I need to go Google that up.
I don't even know how you work that into a conversation.
Well, he would just say, well, we're going to do this vis-a-vis something else. And I'm going, well, what does that vis-a-vis thing mean? But anyway.
He integrated it into his conversations well, is what you're saying.
That's a good segue into that, Megan. Congratulations. So if you listen to our PodCLASS number 5 on the topic of estate planning, back then I was explaining why I have such a passion for helping people get their affairs in order. And that is because back in 2019, Mr. Einstein here, I actually drove my car into a flooded roadway at night and had to swim back to the street just to keep from drowning. And
Show off.
Yeah, well, I mean, I had to swim back on it's hard to swim with your clothes on, let me just tell you, particularly at night. But, sad part was that someone actually drove in the same place after me. He actually died as a result of that. So I got to know his spouse or, his widow at that point in time. And that's why we kind of focus on helping people organize their affairs. Okay. So that was kind of the basis of that.
So after he swam out of the body of water from his car sinking, which was a very interesting night, he did decide that that's a good reason to explain how to organize investments to his clients and hopefully to other people. Because here's the deal. We are materially improving the long-term financial lives of our clients because of these conversations that we've been able to have with them. And we think you would want to know how we're doing that. And because it took us a long time to figure this out, we want to kind of speed the process up for you. So we're not saying we're the only ones who are using this approach, but I would be willing to put some money on the fact that we're probably the only ones telling you about it on a podcast, aren't we?
I'd bet a lot of money on that. So let me just say, and I may have said this before, I've been in this industry for like 40 plus years. So I don't know, 42 or 3 years, I suppose. You lose count after 40. And looking back over all of that time, I've always tried to have the best interest of the client in mind. Now, to do that, you need to start off by understanding what's their situation, what are they trying to accomplish, what's their goal, what's their level of risk that they're willing to take. But you also need to understand the various investment options that were, at any point in time that are available to you, because a lot of stuff today wasn't around 30, 40 years ago. And you try to figure out, okay, what's a good fit? And over the years, I've also met hundreds of what we're going to call them investment company sales representatives from mutual funds, annuity companies, all of that. And many of those people, they'd pay for lunch, and they would tell us that their mutual fund or their annuity or their whatever it was better than everybody else's. Okay. Some of the information they gave us and the ideas they had were pretty impressive. But you come to realize that there's some things that, worked a little bit for a long time. Some things worked maybe really well for a short period of time. Some of this stuff really didn't work at all.
So what you're saying is the vast majority of anything was not significantly better than everything?
What did you just say?
Okay, so I just coined that phrase.
Oh. You're making stuff up, which is good.
So in case you didn't catch it, I'll say it again. The vast majority of anything was not significantly better than everything. Get it?
I was going to say I couldn't say it better myself, but I'm not even sure I could say it, period. Well, anyway, back to your question. Yeah, I guess so. Back in 1982 when I started, for probably, let's say the next 25 years, I never really had, and I'm just going to admit this, I never really had what I would call a core strategy that I felt was going to benefit, virtually any type of investor. I mean, it'd be some things would work for one person, something else would work for another. And I really didn't know anything that I would say check all the boxes, such as better than average return, or maybe lower than average risk, or also the ability to manage this at a lower than average cost. Let's put it that way. So between 2001, 2008, as Megan mentioned earlier, I was actually the manager of what was back then Wachovia Securities at the time. And that later became Wells Fargo Advisors, as banks and investment firms like to change their name. But around 2007, we acquired an investment firm in St. Louis. It was called A.G. Edwards, really good firm. Some of you may have heard of that. And as I got to know the financial advisors, as we integrated them into, from their office into our office locally, they would start to tell me about this research list they had over at A.G. Edwards called DSIP.
You may have heard us talk about the DSIP list in the pod classes. If you've listened to any of them, there's a good chance that you've listened to one that we've talked about it. And it stands for Diversified Stock Income Plan, which is why it's abbreviated down to 4 letters. We love a good acronym, okay? So this was a research list that had been in existence at A.G. Edwards for about 13 years, like my dad said, and it actually transitioned over to Wachovia Securities at that time.
So way back when, I was repeatedly reminded by all my little associates from A.G. Edwards, they'd say, what great performance this list had. But for whatever reason, I didn't pay much attention to it, for quite a while. And here's the problem, that over all these many years, I've seen so many things that were maybe I hate to call them a flash in a pan, but I really didn't have the confidence that this DSIP list was much better than anything else, that maybe it had kind of mediocre performance. You just kind of go, well, okay, I'll keep an eye on it. Well, I finally took a serious look at it, and DSIP seemed to be different, but I still was kind of skeptical. So it took me, I guess, about 6 months, and I digested what I consider to be every piece of research that we had on the list. I just sat down and just read it. And in DSIP, it was created way back in November 1993. It started again at A.G. Edwards and eventually transitioned over to Wachovia, then to Wells Fargo. And when I first looked at it, it'd been around for maybe 13, 14 years.
At that time, the track record had been about 12% per year versus the S&P 500 index return, which had been about 9% per year. So that was significantly more return than the index for its first 13 years. And over the last 17 years, has that superior performance of the DSIP list declined? It has not. So let me repeat that. The rate of return since the 1993 inception date of DSIP was about 12% per year back in 2007. Here we are, 17 years later, and the rate of return since the 1993 inception date is still 12% per year.
I was just thinking, Megan, the only thing better than that would be if it had like French onion dip on it, kind of like on a potato chip. Doesn't that sound good?
I could think of a couple of other things I like better than French onion dip, but sure.
Well, I don't know. I guess I'm hungry at the moment, but you need to understand the actual performance of this DSIP list is because they were able to identify that stocks with certain characteristics tend to perform better than much of the rest of the market. Now, there's nothing really magical about the fact that the track record, it now spans 30 years, and it's been 12% a year, on average for each of those years. So obviously, as you've heard many times, we've said it a zillion times, past performance doesn't guarantee future results. We get that. But 30 years of outperformance to this level seems to be a heck of a lot better investment idea than a lot of other options, doesn't it?
I would say yes. And, if you're new to our pod classes, you need to understand the characteristics of the stocks on the DSIP list, and that they are generally large. They are higher quality companies with a history of raising their dividends. Now, these are not necessarily the companies with the highest dividends, but they are the companies that are increasing the dividends at a fast rate. Okay. They're also companies that have very high quality debt, if any debt at all, really. And they have core businesses listed that many people either know and or use. These are places that you are purchasing products from, okay?
Well, like Costco, Home Depot, Walmart, things like that. You've probably heard of Apple. That's also on the list. So these companies, as a group, they're very attractive to investors because they not only have the ability to pay a dividend, which is not that unusual, but they have the ability to increase those dividends each year. And guess what? That's what they do. In fact, these companies are so attractive to investors that the stocks are technically less volatile and they tend to decline less when you go through a market correction because people they're less likely to sell off. They're just very loyal to these companies because they trust them.
Right. And so the advisory accounts that we manage, they actually focus on stocks with the same characteristics as the stocks from the DSIP list. And our advisory fee is probably less than any advisory fee that you actually are probably currently paying. The fact that we're investing in individual stocks versus mutual funds means we're avoiding all of those mutual fund costs we've been explaining over the past couple pod classes. Now, this approach is also far more selective as to which companies the money is invested in versus being overly diversified, what we like to call diversification,
Dun, dun, dun.
When you have, your money scattered over 15 to 20 mutual funds with just mediocre performance.
You're listening to an Organized Investor PodCLASS, which makes up our College of Knowledge. Your hosts are Megan Hubbard and her favorite father, Jerry Goodman. You'll benefit most by listening to at least 12 PodCLASSes. And the best way to be reminded is to subscribe on your favorite podcast platform.
So going back to PodCLASS 11 and 12, which wasn't that far back, we explained the historical performance of our advisory accounts that we managed and why it's so much better than a mutual fund advisory account that we used as an example. So as a reminder, as of January 2024, at that time, we had 84 advisory accounts that we managed that had at least a 5-year track record. And the average 5-year net rate of return, which is after any kind of fees or expenses related to that, the net return to the client was 14.06% per year. Okay, so if you extrapolate that 14% return, say going forward over a 5-year period, it's equivalent to an increase of about 92%. So it didn't double in value, but came pretty close.
That's right. And so if I just kind of give you a brief summary of the DSIP list and how we've been able to use it to help clients, I would say that it took my dad probably 6 years?
6 months.
Just kidding. 6 months to recognize this strategy for what it really was.
And 6 months was long. Actually, 6 months was long enough. I mean, but 6 years, that's an oversight.
I was just making sure you're paying attention. We want to sufficiently explain and continually pester you about this so you will understand it as well. And it doesn't take you 6 years or 6 months to figure out what we're talking about here. So after explaining this process to lots of people over the years, we have realized that until you actually understand the potential of owning the companies that increase their dividends, everything else is really kind of irrelevant.
Yeah, or irreverent, perhaps. So, in other words, we can sit here and explain how the accounts function, and what we do in terms of managing the accounts and all of this and that. But until, as Megan said, until you realize that these types of companies that raise their dividends, they have much more potential. Until you realize that, all this other stuff is really kind of irreverent, irrelevant, or whatever. Okay, so we suggest that you be patient, keep listening to a number of these PodCLASSes. Your own investment's going to be a little bit of time. Plus, you get to hear all this funny stuff we're saying. And we try to be as entertaining as much as the content will allow. Okay? And at least we think we're funny. We like to hold that in our thought.
If you don't think we're funny, just let us think we're funny, okay? Now, in case you'd like a little more supporting evidence than just the DSIP list, because I'm I want tangible things that I can look at. So I understand that. So on the investments page of our website is information from Ned Davis Research. And they did a study that shows the outperformance of stocks with a history of raising their dividends. Now, that study, it covered 48 years between 1973 and 2021. And it showed companies that either initiated or raised their dividends and had an annual rate of return of 10.6%. Which that's also much higher than the S&P 500 index for that same time period. I just want to point out.
So as much as everybody likes to do research, and that's kind of supposed to be funny, but anyway, I would say anybody's welcome to do all this research on your own to kind of prove that, these types of companies, they have outperformed. But you have to spend a lot of time and money in the whole process. And who wants to do that? We're certainly not going to try to reinvent that wheel for this, but we do have access to the list and all the supporting research. And that's what helps us to build portfolios that, again, focus on these types of stocks. So we have the luxury, we've said this many times, we have the luxury to get to brag about this list, and which is okay, because it's not even our list. It doesn't sound self-serving. This list is coming out of, what was A.G. Edwards, went to Wachovia Securities, now it's at Wells Fargo Advisors, the Wells Fargo Research.
Yes, it's really more of a mission for us to share it because it's so important for people to know about it. So the 12% return of the DSIP list over that 30-year period, it's actually made up partly from the dividends each quarter that are paid out, with the majority of the return being from appreciation. So in other words, the 12% return over those 30 years is probably from a dividend of maybe 3%, and the other 9% would be from the increase in the stock price. So the majority of the return is actually paid from price appreciation, and that's because a company that consistently increases its dividend is very attractive to investors. It's also why these stocks tend to have less price volatility because investors, they're just more likely to hold on to them, even in a market downturn. They don't want to give them up.
So on occasion, we'll have people will talk about price volatility, and someone will say something like, well, I don't worry about the downside. But when you say that, it's usually because the markets are going up at the moment, and you kind of forget about the downside, the down times, and the negative side when they're actually going down. So as I mentioned, as time goes by, it's easy to forget about, say, the bear market. Like, remember the tech bubble of 2000, 2001? Or let's not forget the great financial crisis. It started 2007 in the fall, ended like 18 months later in March of 2009. It was awful. Okay, it really felt like everything was literally going to collapse in the financial world as we knew it. And it was all going to come to an end. Now, if I sit there and say that, you may scoff at those comments and say, "Well, yeah, that didn't happen." Well, but at the time, that was the fear, that was the concern, and this was a time, folks, when things were happening that had never happened before. And obviously many moons have passed, and obviously the world didn't come to an end, but that's another reason why we focus on stocks with a history of raising their dividends, because we remember those times. We remember how difficult it was. We saw people lose a lot of money in things that went down a whole lot.
I had a baby in 2007. It was a great time to think about bringing a kid into the world. I thought, oh no, what have we done? That was the second one too.
There's got to be something funny I can say about that, but it's not. I got nothing at the moment for that.
No, it wasn't funny. That wasn't a funny time.
I'm talking about the baby. I'm talking about the baby, not the market. But there's an analogy. I just can't come up with it.
We'll let you think about that for the next one. Anyways, so on our investments page of our website, theorganizedinvestor.com, you can actually view the historical performance of the DSIP list, and that includes the calendar year of 2008, the highlighted year of the market. We have it there to make this point. Okay. So during that one calendar year of 2008, which was during the great financial crisis, you'll notice that the DSIP list actually dropped 24.5% in that 12-month period. Okay. Now I know that sounds bad, right? You're like 24.5%. But listen to this, the S&P 500 index, it actually fell 37% during that same period. That means the S&P 500 index dropped 51% more than the DSIP list.
Yeah, those were fun times. Now, let me just clarify one thing that Megan didn't mention this. On the investments page of our website, there's actually two historical performance reports for the DSIP list. One of them is like the most current one from, say, early 2024, something like that. The other one that she's referring to goes back to like 2000 and I don't know, 12 or 14 or something like that. And we put that also on the investments page because it included that year, 2008. We had to go kind of dig through the tombs and resurrect that one to put it on there so you can actually see how much it dropped in 2008, because those numbers drop off every year that goes by, and that 2008 number is not in the current summary. So we're on the subject of dropping in value. So let's talk for just a second. Let's remind you the mathematics of why you want to avoid losses. Because if you take an investment, it goes from, say, it drops 50% in value. It goes from $100 down to 50. How much does it have to increase to get back up to 100? It has to double in value. In other words, you need a 100% increase to get that investment that's $50 back up to 100. And the fact that the DSIP list dropped much less, than the S&P index back in 2008, this is all a fact that and let me say the long-term volatility is much less as well. It's because investors are much more loyal to these types of companies. They don't see them as risky. They don't feel they're going to go out of business. That they're just very highly regarded, and so they're not as apt to sell them.
Now, if your reaction is, well, I don't want to own something that can drop by 24% per year, I understand that. But that's really not the point. If you want to earn stock market rates of return, there's a certain level of risk that comes with that level of reward. And if you want the risk level of a CD, you're going to get the return of a CD, right? So the hope of getting a 12% return from owning stocks on the DSIP list means there's a chance that something like the Great Financial Crisis actually might happen.
So if you're willing to be subjected to some of this risk, if that's okay, and you recognize that, the companies on this DSIP list, they should have less risk than the market as a whole. That's just kind of what history has shown. And the takeaway from this, the DSIP drops significantly less than the S&P 500. Again, it is a testament that people trust these types of companies that are on the DSIP list. So they see these companies, as I alluded to a minute ago, financially stable, less risk of going out of business. And in fact, during the Great Financial Crisis, virtually every company on that list either paid the same dividend or even increased it, which was pretty darn impressive considering what was going on.
So that's why companies that constantly raise their dividends are so attractive and why their shareholders are loyal and less likely to sell them off. And the fact is, the rising dividend strategy, it works. It took us a while to understand it and adopt a process we're confident with, and why we need to repeat all of this to you multiple times and in multiple ways. So we would just ask that you keep listening as we keep explaining.
So we try to cover a lot of things in each one of these little podcasts, and we hope you find the information informative and helpful. This really is a very convenient way for you to hear what we're sharing and to learn a lot of things that maybe you don't know, but maybe you need to know. So much of this is for the benefit also of our clients' family members. Now that's kind of weird. Like, why not someone who's not a client? But for our family members, there's two reasons why we do this through these podcasts. First, it makes for a very smooth transition when those family members actually become beneficiaries, so they kind of know what's been going on with their family's accounts. Second, it also allows that family member who they may want to benefit from some of this personally. I mean, like right now, not 20 years down the road, there may be some benefits that they derive from this. So this is one of the reasons why we do these podcasts.
And if you're not yet a client of ours, we do invite you to listen to our approach and then sit down for a chat to see if working together would be a good fit for everyone involved. Maybe we need to take you through the envision planning process we explained in episode 3, or maybe you have questions about estate planning, and we covered that in PodCLASSes 4, 5, and 6. Either way, we're here to help and we're happy to help, but you do need to get in touch with us and just let us know that you need that help and that guidance and want to know more about what we're doing or what you need to do. You're also welcome to join us for one of our live in-person workshops that we conduct in the conference center of our building. You can come see us, realize that we are live and living people who maybe are a little funnier in person. Probably not, but I don't want to.
They'll realize, Megan, that we're not as bad as everyone says. That's the goal here. Okay.
So come visit us for one of our live in-person workshops. These are held at the Landmark Center, which is located at the Paper Mill exit in West Knoxville off of I-40. Very convenient, easy to get to. And on the workshop page of our website, theorganizedinvestor.com, we actually have a reservation page, and you can find the dates and the times. There's a video on there to give you a little preview of the live and in-person workshop. And this also will allow you to reserve your seats because there is food involved. So you definitely want to make sure that we know you're coming so that you've got something to eat.
So our very favorite part of this whole podcast episode is when we get to explain to our listeners that the rates of return we share are for informational purposes only. And even more exciting is that past performance is no guarantee of future results. How many times have we said that, Megan?
Just a few.
A few. So the returns for each of our client accounts, these are based upon the client's individual circumstances, such as, and they can vary based on that, based upon their age, when they started the account, their investment objectives, things like that. Now, the rates of return for these advisory accounts, they were compiled from a month-end performance report for each of those 180 accounts, respectively. And it's way too much information to put on the website in any sort of understandable way. It's too much information. And in addition to covering that summary information here, we're happy to sit down and have a face-to-face chat with you, maybe have a Zoom call if you prefer, and go through all this. So in other words, we have a lot of boring information to back up all these somewhat boring statistics, and we're happy to cover all of it with anybody that might be brave enough to let us do that and sit down with us.
Yes. If you're looking for a sleep aid, we could set up a Zoom call about your bedtime and we'll just read all of it to you. Oh,
It's riveting.
Anyways. But in all seriousness, please do feel free to contact us with any questions you may have, or if you want to talk about this information regarding our advisory accounts that we manage. And also, be sure to follow us on social media. We're on YouTube, LinkedIn, Twitter, and you're going to want to make sure to save us to your favorite podcast player. Go there, subscribe to our show, and that way you're going to receive reminders of any future episodes that we release and stay up to date. Also, we have more to share, which means you have more to learn. So we ask that you join us next time. As always, thanks for listening, and class is dismissed.
The information covered and posted represents the views and opinions of the guest and does not necessarily represent the views or opinions of the Organized Investor or TN Wealth Management. The content has been made available for informational and educational purposes only and is not intended to be a substitute for professional investing advice. Opinions expressed are subject to change without notice and are not intended as investment advice or solicitation for the purchase or sale of any security. Always seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your investment planning or before making any investment decision. And please consult legal or tax professionals for specific information regarding your individual situation. The Organized Investor cannot accept trade or account instructions on or through this platform. Please contact us directly at contactus@tnwealthmanagement.com or 865-415-2060 to place a trade or for trade or account-related questions. Brokerage and advisory services are provided by TN Wealth Management through Prospera Financial Services, Inc., member FINRA SIPC. The Organized Investor is a brand name operated by TN Wealth Management for educational platform purposes.